Welcome to Inside India. I'm Amitabh Singh, back here in the SGX studio. These are your headlines. The tech sell-off continuing in Asia with the Hang Seng Tech Index now in bear market. We'll be tracking India tech stocks when they open this hour. Additionally, BlackRock's Larry Fink calling on Indians to invest for the long haul in India's growth story at a Geo BlackRock event in Mumbai, calling the era for India will be over the next 2 decades. And the US-India trade agreement may have taken some of the pressure off the central bank to ease rates as we count down to the decision tomorrow. Let's get the ball rolling with a look at the Asian markets. It's a sea of red almost. Asian markets have mostly fallen as the SaaScopalypse, or however you pronounce it, an apocalypse for software as a service stocks, kind of continued, triggered by Anthropic's new add-ons and improvements to its AI model. The tech sell-off on Wall Street playing into sentiment right here in Asia too. South Korea, of course, leading down by almost 4%, 3.74%, as chip heavyweights Samsung and HK Hynix also fell more than 4% respectively 3 days before election day in Japan, and the Nikkei there falling also about 0.75%, led by investment firm SoftBank Group, declining nearly 6% after chip designer ARM's Q3 licensing sales missed estimates. The oil prices have fallen too as the US and Iran agreed to hold talks in Oman on Friday. US crude and Brent were down about 1.4%. Crypto too following Bitcoin entering Asian trading day with full bear market signals falling below 73K. And we're watching China very closely. The Hang Seng down 1.5%. Shanghai Composite down about 0.86%. Now continued selling pressure for tech stocks in Greater China. So let's actually get to Emily Tan in Hong Kong for the latest deep dive on what's going on. Emily, over to you.
Amatoja, thank you very much, and welcome back to the studio. We are keeping track of some of the weakness in the Hong Kong markets, evident in the tech plays. We've got a weakness for the Hang Seng Index, the benchmark blue chips down 1.5%, the tech index down more than 1%, and officially now in bear market territory, falling about 20% since its October 2nd high. And you could see last traded now at 5,296. The Hang Seng Tech Index has been down for 5 consecutive sessions. It'll be 6 as we continue on this track for today. The weakness does continue. Pull up some of the heavyweight stocks. We are zooming in on Tencent, which was amongst the biggest drags on the benchmark yesterday, pulling back by 4%, down 3% as we speak. Alibaba shares down 2.5%. Meituan and Baidu down more than 0.5%. We're also tracking some of the other China tech plays, so you can flip the boards and I will follow along this as, of course, the continued weakness in this sector. We got NetEase shares down 1.3%, Kuaishou and Bilibili shares both down more than 3%. As we worry about AI spending, overspending, we look to the epicenter of that, and of course, most of these AI chip designer companies like NVIDIA, AMD, they make at TSMC. So I want to look at shares of TSMC and the company's CEO, C.C. Wei, currently in Japan, talking through with Prime Minister Sanai Takaichi about the factories in Japan. And they're going to be manufacturing 3-nanometer chips at their Kumamoto plant. And C.C. Wei saying that they're discussing with Japanese customers for further collaboration. Prime Minister Takaichi, for her part, saying that the 3-nanometer chips will be used in autonomous vehicles and robotics and have great significance for their economic security. Now, this comes as TSMC is expecting investment in Japan totaling $17 billion to produce their 3-nanometer chip technology there. And with this latest indication to bring the advanced technology to Japan, it will not just be exclusively reserved for the United States as they build out over in Arizona and in Phoenix. TSMC shares down 0.8%, 1770 last traded in Taiwan after a 3% pullback in its ADSs. Amatoj, it's back to you.
Emily, thanks so much for that. The Indian market's coming online in about 41 minutes. Here's what GIFT Nifty futures are indicating. It's a hold on a positive bias, according to analysts. The US-India trade deal news really keeping things on the positive side. The hope is that this will revive foreign inflows. GIFT Nifty indicating the market will open just above that Wednesday close of 25,776. Watch out for IT stocks as the AI and tech sell-off in the US and South Korea really could continue to impact India after its IT index fell, guess what, 6% on Wednesday, its biggest daily drop in nearly 6 years. There might be some caution among traders as we await the RBI's rate cut decision tomorrow, where expectations are steady as she goes. We're also watching latest data, but let's just talk a little bit about what's happening with India's imports of Russian oil. They've fallen in January for the second straight month as refiners shifted to alternative supplies amid US pressure. India bought about 1.2 billion barrels per day of Russian crude in January, down 12% from December and well below November levels. Reliance imported none last month. The shift follows a US-India trade deal in which Washington cut tariffs to as much as 18% and expects New Delhi to curb Russian oil purchases. However, Moscow says it sees no change in India's policy, and Indian refiners reportedly say they have not been formally told to stop oil from Russia. India's services sector regained momentum in January after an 11-month slowdown in December. HSBC services PMI rose to 58.5 as new business picked up, helped by stronger online sales and better marketing. Export orders also improved, especially from Southeast Asia and the Middle East. However, hiring barely grew, signaling still weak labor market. At the same time, costs rose at their fastest pace in September, pushing companies to raise prices. Business confidence edged higher on expectations of efficiency gains and new clients, while India's combined services and manufacturing PMI also strengthened to 58.4. Meantime, the Reserve Bank of India's three-day policy meeting has begun. It's underway. The central bank is widely expected to keep rates unchanged in the decision that's due tomorrow after a long easing cycle. The focus is expected to be on the transmission of last year's rate cuts, where the RBI brought down its key policy rate by as much as 125 basis points, taking it to 5.25%. Now, officials say growth is strong and inflation is moving back towards target, making a policy pause very likely. But bond yields have stayed high, despite easier monetary policy. To talk about that and more, we have Shantanu Sen-Gupta. He's the MD and Chief India Economist at Goldman Sachs. Shantanu, it's always great to have your insights. Thanks so much for joining us. Really appreciate it. I want to start by asking you about this. I know the house view is that the RBI is going to go on with a prolonged pause, perhaps for the whole year. But if the RBI, on the off chance, does decide to go for a cut, what will the impact on markets be?
Thanks, Amitoj. Again, glad to be back on your show. Look, our view is that the RBI stays on hold from here on. I mean, the outside chance that you had of a cut was if the trade deal did not go through, and therefore it would be further headwinds for growth. And in that kind of situation, we would have thought that the RBI needed to ease. But our house view remains that they are on a prolonged pause for now. I think you mentioned something very important. The RBI will be quite focused on transmission of rates from here on. I think they've done the great deal in terms of injecting liquidity in the month of January. Overnight rates were trading higher than the repo, near about the top end of the corridor, which is the MSF. They've injected close to about $20 to $25 billion in terms of liquidity through OMOs, buy-sell FX swaps, term repos. And therefore, that really is going to be the focus from the RBI from here on.
Okay, a couple of questions about that as a follow-up. You've said that this pause will be for the year. The focus is on liquidity and transmission of rates. But what exactly are the risks that you see, and how will you observe this? Because the Economic Affairs Secretary, Anuradha Thakur, telling Reuters just yesterday, that the borrowing plan will make sure rates are competitive, and the market is not disturbed. The government will use those bond switches. But do you see any risks, particularly when you think about bonds?
Well, I think it's then a question of which part of the curve, right? So the liquidity injection helps in the short end, and especially in the transmission in the short end rates. If you look further down the curve, with the amount of supply that you have now of government securities post the budget, net borrowing at around 11.7 trillion INR, the gross borrowing near about 17 trillion INR, already at the end of a curve, cutting cycle, so the curve was already steep. So we don't think bond yields at the belly or even the long end will materially come off, just given the supply. I think there are two things also further going on. A, banks have not been big buyers, and B, insurance and pension, who have been significant buyers in the past couple of years, especially in the long end of the curve, have stayed away a little bit due to multiple local factors. Some of that will come back, but our view is that the curve will continue to remain steep, just given the supply. But again, the RBI's focus will very much be on the short end, on liquidity injection, such that you have transmission, at least in the short end, come through.
Okay. There are a couple of other factors. There's been budget and there's been U.S. trade deal. We'll come to that in a bit. But in the context of nominal GDP, which is aimed at about 10 to 10.5% for FY 2027, is it concerning that it's been well below its historic levels? And I say this because you have that, the new CPI basket, the inflation basket on Feb 12th that's coming. And you say that inflation will look slightly higher by about 40 basis points by the middle of the year. So do you see a scenario in which, because of all of that, the RBI could do a rate hike during this year?
Well, our base case is not that of a rate hike. And just to be clear, the 40 basis points higher inflation on that basket is if you put the earlier index into the newer weights. But remember, the index will also change, and there are a couple of new sectors that the new basket will be looking at, namely, let's say, e-commerce prices, media and entertainment, so things like Netflix and so on, and they'll be widening the basket of housing rentals into rural and urban. So we'll have to see how those indices work out in terms of where inflation lands up. But yeah, our sense is that you would be, in any case, closer to 4 to 4.5%. By the middle of the year in terms of headline inflation. At 4 to 4.5%, we don't think the RBI is really calling for would be looking at a hike. If core inflation rises, and there are multiple factors working there, but our view is that it remains around 4. But if core inflation indeed rises above 4% ex gold and goes towards 5, that's the situation where the RBI could be, or at least the market will start baking in the fact that the RBI could be hiking later in the year. On nominal GDP, finally, look, you had a very low inflation cycle last year, where CPI inflation on a headline basis actually came to near zero by October. In that kind of a year, you would expect nominal GDP to be low. Real GDP was high, around 7%, but nominal around 8.5%. As your inflation normalizes towards 4.5 by the middle of the year, our view is that nominal GDP will also pick up towards about 10%. So, which is where the government has estimated in terms of the budget numbers. So we think you're going to go back towards that 10% mark in terms of nominal GDP growth. We are not really seeing 11 or 12% come through this year. That's more of a couple of years away.
Just about the rupee, if the downward pressure on the rupee has lessened, how much has it lessened by because of the trade deal? And do you expect more overt support to reverse the rise in bond yields on the support that has been given to the rupee?
Yeah, great question again. So there were 2 or 3 things happening on the rupee, right? One, your current account had widened because you had a front loading of exports, and then sort of your exports are coming off a little bit towards to the US, and there was a lot of gold imports. B, you had this FII selling on almost $20 billion last year. And C, the RBI still has a large short forward book of around $65 billion. 1 and 2 have been lifted somewhat, right? Your exports will be better to the US going forward after the trade deal is done. Our sense is that the FII selling that you have had, that magnitude at least will come off. There are other headwinds in terms of AI, etc. But at least that magnitude will come off. The short forward book still remains. So we think that it's abated. We still think that the rupee will be in this 90-92 kind of. We don't foresee this rallying towards 88 or sub 90. And the main reason is because if you even have inflows, the RBI will want to first knock off the short forwards or accumulate reserves. So we don't really foresee a situation where the rupee rallies materially towards 88 or so.
So it sticks around 90 to 92 is what you're saying?
That's our view, yes.
Okay, great. There's so much to cover. Let's start with the oil because it's perhaps so important. Iran and the U.S. Set to have talks tomorrow in Oman. The trade deal with the U.S. and its impact on India's import bill is a big talking point. Supposedly, India is going to be buying from the U.S. as part of that deal, and then Venezuela too. So, and you've said on record, as I understand, that India is importing 1/3 of its oil need from Russia. That's about 33%, about 1.5 million barrels a day. I want to understand how you got to that conclusion, because what we've heard is a couple of different things. I've asked this question to the Energy Minister, Hardeep Puri, at Energy Week, and we didn't get a clear answer. ET report citing a Center for Research on Energy and Clean Air, saying that Russia supplied about 25% in December. JP Morgan note cited by Reuters saying that is about 17 to 21% of your total crude imports. Your conclusion on the import bill that is not going to have a material impact is based on that 33%. So where did you get that number from?
Well, the import volume shares are very much available in the public domain. So if you look at the overall import share, India imports ballpark 30 to 35% from Russia. That's around 1.5 million barrels a day. I think you pointed out at the start of your show that it's come down to 1.2 million barrels a day. So the point is that, we don't foresee a situation where this 30-35% will go materially lower towards zero. I mean, it's very difficult to convert this to zero immediately. It can happen over a period of time. So we think that this will pan out over a period of time where the share of U.S. imports increase. That has already increased. You'll find the U.S. is now accounting for around 7% of crude oil imports from about 2 or 3%, call it a year back. That will continue to increase. The other thing that had happened over the last 2 or 3 years was that the Latin American share, primarily Venezuelan share, had come down. And now you'll probably see the Venezuelan share also increase. So again, our point is that it's very difficult to imagine that this will quickly go to zero immediately, but over a period of time, it will start going towards lower imports from Russia and higher from US, Venezuela, and probably the Middle East also.
So I guess the question then is that how is it that this will not have a material impact on our bill? Because perhaps not in the short run, because you're saying it's going to take some time, but in the long run, that Russia discount factor will be removed effectively. Venezuela and US oil will potentially be higher, right?
Our sense is that you're already paying quite a bit of higher logistics cost for the cheaper crude oil imports from Russia. So that was netting off a little bit. In our view, the main issue for external balances at around $60 oil is not really so much the oil prices. So, India will really start hurting if oil prices move towards $80, $85 a barrel or higher in terms of the current account. But the main issue right now is what happens to services exports, right? So services exports have increased from about 7% of GDP to 10% of GDP. If there's a situation where the services exports start getting hurt, that's when the external balances will widen towards 2% of GDP or higher current account deficit, which is what might impact the currency in a bigger way rather than just oil prices.
Just talk to us about the other part of the deal, $500 billion target of exports to the U.S. from India, 100 per year. We're at about 45 billion, and even if that's slightly higher, as you've indicated in the past, you've said that defense and energy trade-ins will happen, and that's what will bring it closer to the 100 mark. Machinery, capital goods, higher-end tech products is what you've said. But do you think all of that will bring it from 45 to 100 in 1 year or even 2?
To be clear, the surplus that India is running in terms of the trade balance that's the number which is about 40, 45. The total exports in terms of goods is near about $80 to $90 billion. So the surplus that India runs is mainly in electronics, textiles, gems and jewelry, to an extent the pharma products and so on. That will remain closer to the trend that you've been seeing in recent years. $500 billion is, I think, a long pathway. We don't think you're looking at moving to $500 billion overnight, but the trade relationship deepening will mean further defense imports from the U.S., for the energy imports from the U.S., and India will also get a bigger market to the U.S., and that's what will get you towards a deeper trade relationship.
Shantanu, there's so much to talk about. We didn't even get into the budget, but we'll have to let you go. Thanks so much for that. Really appreciate you coming on. Shantanu Sengupta from Goldman Sachs. All right, coming up, commodities markets are on the edge. We'll take a closer look after a very short break. Welcome back. A look now at oil prices in Asian trading. They've extended their declines by, well, nearly 2%, 1.90 for crude, light crude, and 1.91 for Brent crude. The US and Iran have also agreed to resume nuclear talks in Oman tomorrow. Perhaps that's what's impacting the oil prices. The talks will mark the first round of negotiations since April last year. Now, as both sides prepare to meet again, President Donald Trump telling NBC News that Iran's supreme leader should be very worried. This comes in the wake of massive protests that have swept through Iran in January, fueled by rising inflation and economic hardship. The US has not ruled out military options for Iran as regional states urge caution. All of that perhaps having an impact also on precious metals. They've been seeing some volatility over the past few sessions over those cues, jobs data and a firmer US dollar. Gold weakening again right now, down about 1.77%, and silver down 12.68%. Palladium and platinum also right now down 6 and 5%. Now, the US has unveiled plans to create a new critical mineral trading bloc and coordinating pricing flows with allies. The move could challenge or would challenge China's dominance in the global rare earth mining industry. The US Secretary of State, Marco Rubio, saying the minerals are heavily concentrated in one country without directly referencing China. He also added that 55 countries attended the talks in DC, including India, South Korea, Thailand, and Japan, and many have already signed on.
I think there's a growing global recognition that we need to have supply chains for critical minerals that are reliable and diverse across the world. Some countries have a number of critical minerals that they have available to them in terms of mining, but just haven't been able to do it because a foreign competitor will come in, they'll gut the price, they'll undercut it through state subsidies and unfair practices, and so it becomes economically unviable to be able to explore for critical minerals.
The Trump administration has put critical minerals at the center of its trade policies. On Monday, the U.S. government launched a national critical mineral stockpile, and so far, it has taken equity stakes in critical mining companies, including MP Materials and USA Rare Earth. U.S. President Trump saying he had a, quote, excellent call with China's President Xi Jinping. They talked trade, oil purchases, and Taiwan, among other key issues. CNBC's China reporter Elaine Yu has the breakdown. Elaine?
Hey, Amatosh. So the Chinese president had quite a day with back-to-back calls, actually, with both President Trump and President Putin. And with the call with Trump, Xi acknowledged the turbulent times that they're in, saying that he hopes to work with Trump to steer relations through winds and storms and to accomplish more big and good things. And according to the Chinese readout, President Xi emphasized that Taiwan is the most important issue in U.S.-China relations and warning the U.S. must handle the issue of arms sales to Taiwan with prudence. Now, as for Trump, he said on his Truth Social that the call was not only excellent, but also long and thorough. And he covered a long list of subjects discussed, including trade, the military, the upcoming trip to China expected in April, and Taiwan, and the Russian-Ukraine war, as well as the situation with Iran. And it's interesting to see chatter on Chinese social media, quite fixated on this point, wondering what they could have been talking about and the intricate dynamics the U.S. and China has with Iran. But they also talked about oil and gas purchases by China from the U.S. potentially, and also airplane engine deliveries. Now, Trump says China could buy more soybeans this current season and committed to 25 million tons for the next season. And he said the personal relationship he has with President Xi is an extremely good one. And he said both realize it's important to keep that up. And this sounds like they're paving the way for the expected meeting between Xi and Trump in person in Beijing. But it's also important to note the Putin call, the video call that President Xi had, where the two Chinese and Russian leaders held their ties and talked about strengthening practical cooperation. And Xi said a grand plan is needed to further bilateral ties. And according to the Kremlin, Putin also accepted an invitation to visit China in the first half of this year. So you could have both the U.S. and Russian president visiting China in the coming months. Amatosh?
No, thanks so much for that. I'm sure we'll come back to you when there are more details. Now, Prime Minister Narendra Modi will be on a two-day official visit to Malaysia this weekend at the invitation of Prime Minister Anwar Ibrahim. The two leaders are set to hold discussions to strengthen bilateral ties. This is Modi's third visit to the country and the first after the elevation of the India-Malaysia bilateral relationship to a comprehensive strategic partnership. Coming up, we will speak to Bipin Preet Singh from MobiKwik on the company's strong quarterly earnings. Stay with us. Welcome back. We're counting down to the market open in about 15 minutes. This is how we're shaping up. Still looking positive. Overall, the sentiment, Nifty 50 closing at 25,776. Nifty futures, 25,803. And the rupee, well, it's weakening against the US dollar just a bit. But overall, it's been strengthening after the US-India trade deal. We're watching a number of stocks. We'll come back to this in just a bit. Now, let's focus on BlackRock's Larry Fink. He said it will be the era of India over the next 2 decades. In a panel with CNBC TV 18's Shireen Bhan and Reliance chairman Mukesh Ambani, Fink also shrugging concerns of an AI bubble and saying the real risk is not investing in AI, as he called on Indians to invest in the country's growth story.
When you think about the growth of India, it's not a quarter, it's not a day or a week, it's not a year, it's over a long horizon. And you could say maybe this is the era for India and over the next 20, 25 years. But if you use that as a foundational paradigm that we all want to think about, the era of India, forget about the era of investing for a second, but the era of India, the key for us, the key for BlackRock is to compel more people to understand what does that mean, the era of India, and how do you participate in it? What we've learned in the United States, for that segment of the population that had invested with the growth of America, they're far better off than those who just kept all their money in a bank account. Mm-hmm. And so the key is, if you believe in the era of India, forget about the era of India, investment, the era of India, which I believe in, we need to get more people investing alongside the growth of the country. And that's the role of the capital markets. That's the role of what we can be doing together. And to me, whether it's, you want to focus on AI, or you want to focus on how we live, how we grow, how we educate ourselves, to me, those are subsets of the era of India and the opportunity to be an investor alongside the growth of India. And to me, that's a compelling story. It's not about, about tariffs or President Trump or anything else that's top of mind.
Well, we do hope that foreign investors take note of that particular statement. Now, Fractal Analytics is moving ahead with its IPO, targeting a valuation of up to $1.6 billion, but at a smaller size than originally planned. India's first pure-play AI company has set a price band of 857 to 900 rupees per share, with the listing expected around February 16. The CEO, Srikanth Velamakani, says investors are still getting comfortable with AI, but demand is rising, and part of the IPO proceeds will fund acquisitions in AI and life sciences. Well, now to the latest on digital payments firm MobiKwik. Big turnaround for the company. The shares surging 16% after the Q3 report card saw it register its first profit. Well, since its IPO, which was way back in December 2024, MobiKwik had been loss-making for several years prior, including FY 22, 23, and 24. It returned to profitability in the December quarter with a net profit of 40 million rupees after a loss of 550 million rupees in the year-ago period, thanks to tighter cost controls, thoughtful scaling, and improving margins is what we understand. The company also cited data from the authority that oversees India's payment system, UPI, saying that UPI transactions for MobiKwik grew 3.2% from a year ago, making the company among the 5 fastest growing UPI apps in India. We have with us Bipin Preet Singh. He's the CEO of MobiKwik to talk more about all of that. Bipin, thanks so much for joining us. We really appreciate it. I know we've been trying to get you on for a while, and I'm glad it's happened at the time of the Q3 earnings. Just for our viewers, India's largest digital wallet, 186 million users, 4.79 million merchants. So there's a lot to go by, but smaller compared to the Google Pays and some of the others, but still, trying to keep up. I want to ask you about the profit. What made the turnaround happen, the first ever for you? And have you cracked the code for the next couple of quarters? Or is this sustainable?
Thank you. Thanks, Amitoj. Firstly, thank you for having me here. I want to correct you to say that we've been loss-making. Actually, that's not really true. We were actually profitable in FY24. FY25 and the last few quarters have actually been an exception, if you think about it, because in the years prior, we were profitable. So for us, we are returning to a more familiar state, which is being profitable. And yes, the last two or three quarters, we had higher losses. And I'm very glad, and we committed to the investors and the shareholders that we'll be turning profitable both at a PAT level and EBITDA level. And so we have turned profitable. Though we are a small company, we have a lot of headroom to grow, given that India's digital payments and digital credit market are still growing very, very rapidly. Our payments volume processed has grown to an all-time high of 481 billion rupees, which is the 12th straight quarter of growth. And the beauty is that we are doing this without spending or burning a lot of money, unlike a lot of our peers and competitors. And therefore, not just growing in terms of payments volume, but also actually having one of the highest payment take rates in 17 basis points, which we have demonstrated in this particular quarter. So I'm very happy with the growth that we have demonstrated in payments, but we have another business, which is financial services, where we distribute credit to the millions of customers in tier 3, 4, and 5 towns who don't have access from banks for conventional credit. Again, that business has seen consistent growth over the past few quarters and reached an all-time high of 9,000 million rupees in this quarter, and also record high margins on the back of enhanced credit quality and great collection efficiency. In fact, it's reached its contribution profit has grown 4 times compared to the same quarter last year. So overall, when you look at our performance compared to the same quarter last year, we have done a swing of almost 550 million or 55 crores in EBITDA and 59 crores, which is 596 million in the PAT. So these are big numbers for us. I believe that we have reached a place where we can be sustainably profitable going forward while continuing to grow. Fintech is a highly regulated business. Digital credit is a business of risk. We are operating in both these businesses. We have multiple licenses from the regulator. So we will be a responsible fintech while continuing to grow as aggressively as we can.
Well, thank you so much for clearing the air. I appreciate that. You talked about risks. I was going to ask you about that. What are the risks to such positive quarters? Q2 was hurt by, I think, a 400 million rupee fraud. And this is not unique to you. This is something that we are seeing in the landscape. That was because of a glitch. So the larger question really is, could India's digital payments growth story, the entire space, face that risk of reputation crisis, the kinds that crypto has faced, for example?
Look, I mean, India is taking its own path towards how, the Indian regulations and the Indian government wants the financial services, fintech, and digital payments to evolve. It is a different, framework compared to a more open framework that we have seen in maybe in other parts of the country, other parts of the world. We have grown up within that. I think the main idea is to protect the customer from volatility, protect the customer interests from things like digital frauds, make sure that the fundamentals of customer protection are in place, including cybersecurity. So I think that the calls that are being taken from a regulatory point of view are the right calls. Yes, incidents do happen like we had in the last quarter, but we look at it as a one-off, and we look at how to learn from it and make the systems robust so that you continue to earn the trust of millions of customers and millions of businesses, small businesses that are there to the length and breadth of the country. And that's really required because, look, I mean, for all the growth of digital payments and fintech, there is still a long way to grow. Like you said, we are still a small company, but there is huge room of growth because the penetration of UPI itself is only 25% so far.
Yeah, I mean, it's interesting you said that because India is now in talks with Ant International's Alipay to link the country's UPI with the global payment platform. This is going to two government sources cited by Reuters. So I want to ask you in that context, how do you plan to differentiate from the competitors, the Paytms, PhonePe, Google Pay, both domestically and internationally?
Look, I think we've been an early participant of the pilots on CBDC, which is India's answer to crypto or stablecoins. Right? We don't have stablecoins in India. We don't allow crypto, in a very formal and open way. So the call that has been taken is a centrally backed digital currency. MobiKwik is one of the few fintechs which is actually involved in the pilots of launching this for retail customers. I do believe that there are merits for making a digital currency throughout the length and breadth of the country. People who can use digital currency on the phone as good as they use cash. For all the advances that have happened in UPI, still it has, it is a single platform and a single dependency. So having a CBDC and making it decentralized and making it available throughout to the retail customers actually is a very good idea. So I think that's one way we are looking to differentiate. But fundamentally, look, our operating model has been that the market is here, the market is growing, and there is a lot of innovation still needs to happen to improve product experience, especially now with AI coming in. New frameworks are emerging in terms of how customers will transact, how customers will interact with payments, how they will take loans, how they will invest. So we look at that as a completely greenfield opportunity going forward.
Okay, I'll bring up AI, but because you mentioned the digital rupee, that was going to be my question. There's a geopolitical shift. BRICS eyeing greater control on the global monetary system. A report basically saying also that India's RBI has proposed linking BRICS digital currencies. All of these. MobiKwik was the first, as you said, digital wallet to go live with a full-scale production version of the e-rupee wallet with the RBI, closely working with that. So what's your personal take on stable coins, which India doesn't allow, doesn't want, BRICS currency, and the dollar, the dollarization aspect?
See, in India, we are the government and the regulators are quite concerned about the volatility that comes from all these cryptocurrencies, as well as the fact that any stable coin, if it is not pegged to the Indian rupee, then it increases risk of currency, which India has anyway seen over the past many quarters and years. So India wants to have its own digital currency, which is digital rupee, and we are one of the early participants in that pilot, and we have rolled it out, and it's continuing to see adoption, although it's still very early days. So I do believe that this is the right call as far as in India's sovereignty is concerned, and given the geopolitical climate, and you've seen how it has evolved over the past few years, especially since last year. I think the call that India is taking is the right one. Having independence and control on your own monetary policy and own monetary currency, I think it's the most important thing. And linking it and using it to facilitate trade with like-minded countries, I think it's a fantastic idea.
Right. Very quickly, the budget, it had a couple of things for you. India carving out 20 billion rupees to incentivize low-value transactions and reimburse banks at 0.15% per transaction value. How do you plan to leverage this 20 billion rupees? Additionally, there was something to the tune of about 100 billion rupees to MSME credit growth, and in terms of AI, a long-term tax holiday for anyone of the foreign cloud service providers operating from within Indian data centers. How is all of that going to impact your ecosystem?
Look, we as fintechs, are the technology players who actually gotten a lot of users and merchants and built a merchant network, the payments network, which facilitates the billions of transactions that you see in UPI, wallets, bill payments, etc. So, as you know, UPI has been free for a while, and therefore incentives are necessary. And I'm very glad that the government has continued in the budget to continue to offer incentives. However, I do think that the incentives eventually need to go away and be replaced with a proper commercial structure, which is the MDR. And I think that's a call from the industry as well, because paying a very small fees on the payments, helps build the network for the next 400, 500 million people who are yet currently untouched by digital payments. So I think that is where we believe that obviously the government has done a fantastic job in helping us scale UPI and digital payments over the last many years. And we see that in everyday interaction with the regulator as well as with the government. But I do think that we have to move away from incentives and to a proper MDR kind of structure.
This has been the industry view for quite some time, but we all keep watching and waiting with bated breath to see what happens and how the government and the central bank actually, adhere to your request. That was Bipin Preet Singh, CEO of MobiKwik. Thank you so much, sir, for coming on and speaking to us. Well, we're counting down to the market open in Mumbai. We're back in 2. Markets have opened. Welcome back. The Indian markets coming online. The Nifty 50 down just about 0.2%. Not too much, about 60 points from yesterday's close. The rupee also weakening against the US dollar. One would have thought that the US trade announcement with India would continue to have a positive effect, but perhaps we'll have to wait and see towards the end of the day if that is the case. We're watching this space very closely. We're watching different stocks. Also, quick check on some of them, the Indian IT majors particularly, because they had a sell-off yesterday, and the weakness that we are still seeing here in broader Asian tech space as well. Take a look. Well, Infosys down, Wipro down. Infosys up now, and Wipro also up. It was down yesterday, quite a bit actually. The entire Nifty IT was down. Persistent is down. Tech Mahindra down about 0.1%. Coforge 0.5% down, leading those negative numbers. All right. Let's now take a look at the shares of Tata Power after the chief executive said Tata Power is exploring future nuclear power projects and is assessing possible sites in 3 Indian states. However, final decisions will depend on clearer government regulations. The company is considering smaller nuclear reactors or SMRs, including small modular reactors. Tata Power is currently in talks with government agencies and both domestic and foreign technology partners. The company also said it expects to comfortably meet its imported coal needs this year. The stock right now down about 1.5%. India has also been ramping up its push into renewables as the country looks to secure energy sources to fuel growth. In its latest budget, it increased its outlay for solar sector spending by about 30% to over 3 billion. It's part of the country's goal to hit 500 gigawatts of non-fuel capacity by the end of this decade. India is also leading efforts through the International Solar Alliance, which the US recently withdrew from, to help countries achieve climate goals. And to talk about that and more is Ashish Khanna. He's the Director General at the International Solar Alliance. So Ashish, thanks so much for coming in to our studios. Welcome to Singapore. I don't know what brings you to Singapore. Why don't you start with that?
So we are here in Singapore for 3 things. The first, even though India has done remarkably well for 150 gigawatts, roughly $150 billion in last 10 years, the international sovereign wealth funds and pension funds have invested less than 1%. So we believe with India's lower macro risk, long tenure transmission assets and stable returns, it's a great market. So we were here to talk to all the investors. What will it take for a large pool of $5-6 billion of investments? That was one roundtable. The second, Prime Minister Modi's vision of one sun, one world, one grid could connect right up to Australia, Singapore, India, Middle East, Europe. And we are trying to see what will it take for undersea cable connections to happen. We had a closed-door discussions with Singapore authorities, possibility of India-Singapore, Singapore-Australia, India-Middle East. That sounds ambitious, but it's really practical. And the third and final thing is we help startups, because startups will disrupt, bring down the cost further. There are 20 startups from Asia-Pacific region which were making pitches to investors yesterday. We facilitated that, so that's the way forward.
What's the takeaway? What's going to happen next?
Well, the takeaway is, first of all, let's look at India. It's already achieved 50% of renewable energy. It needs a lot more investments, $50 billion annually. So a lot more international institutional investors need to invest a lot more.
But India is well capitalized compared to other countries when it comes to this side, right?
That is true. But it's still doing 1/3 of its targets that it needs to meet. So definitely a lot more international capital. As I said, all countries that are doing a lot more solar need to have a good storage policy in the evening. But if you get connected through large sea undersea cables, the need for batteries can come down. Singapore has very high tariffs. India is discovering tariffs less than 4 cents along with storage. So there's a win-win arbitrage potential by getting connection, in addition to lowering the battery costs.
I know your mandate is quite interesting because it's not just about solar, it's about positioning India diplomatically. And I want to bring the point up about how you've been at the World Bank for 20 years, leading energy programs in 9 countries in West and Central Africa. So you're quite interestingly placed in this role in that context. But the question has been from analysts. We were at Energy Week in Goa. I don't know if you were there. Were you there? Yeah, we missed each other. But the question has been that is the ISA able to make India's presence felt internationally? When the US pulls out, and sure, the US is pulling out of all multilateral organizations, but are you being able to do that? Or it's not visible, or that's what I'm trying to understand.
Yeah, so definitely a lot more needs to be done. There's no doubt about it. But I will start off by a very simple statistic, that it took 25 years to do 1,000 gigawatt of solar in the world. Next 1,000 happened in last 2 years. And we, IEA, IRENA, all believe that it will double to 4,000 gigawatt in the next 4 or 5 years. Why is it happening? It's happening for sheer economics. Whether you are a rich country which wants to do energy transition, whether you are an emerging country that doesn't want to compromise on growth for energy, or you're in Africa which wants access, all of them have solar at the heart of it. 90% of all countries have solar as its cheapest source. So what ISA needs to do is, for example, take India's experience to the world, because this low cost and scale at this is happening in India and 1 or 2 countries. India will now, by next year, become the second largest solar after China. So which means Asia will be the fulcrum of solar. We are based in Asia, so it's a very unique moment. And then how do we take small island countries, African countries that are seeing less than 3% of international investments? Our job is to create platforms. We were busy in getting membership. We now 125 countries. Our next phase is to go from pilots to platforms to become much more relevant.
Okay. You've talked about low cost. One of the questions that emerged is that should India increase its target from the 500 gigawatts renewable by 2030, given today's lower cost, compared to when this target was made?
I will say that that's, of course, India's sovereign understanding. The thing I understand, which is much more important, is to actually do storage. For me, India's problem is not only going to be 500 gigawatts, but what's going to be your storage policy, which has 2 or 3 dimensions. First, India needs to do a lot more on different kinds of storage solutions. Pump storage, hydro, lithium-ion batteries, and then a range of new options for which innovation is important. Second, storage should not only be on generation, it needs to be at the distribution end as well. If you ask me, the biggest change on distributed solar and digitization and storage is actually going to be on the distribution sector. So India's focus should be a lot more on distribution sector, because if that side is taken well care, the private sector will invest much more.
Talk to me about whether the budget actually addresses this, because it increased solar allocation by 32% year on year to 300 billion rupees plus. Is it enough in the face of the global uncertainty, the US pressure, don't buy any Russian oil, India trying to balance energy transition with energy security, and the paradigm shift in global energy security that is signaling, well, you got to do it yourself effectively?
So on this question that you have to do it yourself, every country, not only India, is looking at affordability, reliability, and energy security. Affordable means, is it cheap? Reliable means, am I getting it 24/7? Energy security is, am I producing some of it? And I think India is actually a very good example of creating an ecosystem of some manufacturing, local currency. I'll tell you one interesting part, which is underreported in terms of what big thing is going to happen in India, and that's on solarization of agriculture. I was in Davos, where the Maharashtra CM shared the story that 16 gigawatts of agriculture demand is going to be shifted to solar, which is bringing the cost from 8 rupees of landed cost to just 3 rupees, saving $1 billion. And that $1 billion is being translated to industrial tariff reduction to spur industrialization. That's win-win.
Is he talking about Maharashtra or all of it?
It's Maharashtra.
He's talking Maharashtra.
Maharashtra.
Fair enough. Okay.
Rajasthan is doing it. Government of India has a PM Kusum scheme that's 35 gigawatt of solar, expected to be doubled to 70.
Okay, I'm glad you mentioned Maharashtra. For our viewers, Maharashtra is the state which has India's financial capital, Mumbai, in it. It's in the west, southern west. Cities like Mumbai and Gift City, also mentioned in the budget, are attracting a quarter of Indian startups. How can such hubs support India's energy transition when it's been not on pause? They're trying to run both this parallel to the energy security angle, but it's taken a step back.
I'm not sure it's taken a step back.
That's the perspective we got at Energy Week. That
That's true.
It was all about energy transition. Now it's slowed down a little bit.
No, so well, the slowdown is one part of it. I'll say it's calibration. Calibration on quality of energy transition rather than quantity. And in terms of the quality, how startups play a big role on managing flexibility. I go back to distribution. I was part of a chair of a startup which is actually promoting a lot of startups on how distribution, renewable energy is going to be managed more effectively. And more importantly, I'll go back to storage. What are the new storage solutions?
Okay, Ashish, thanks so much for coming on and speaking to us. Great perspective. I'm
you.
sure we'll keep following what you do. That was Ashish Khanna from International Solar Alliance. And that's all the time we have today on Inside India. Of course, keep watching CNBC.